Hello, everyone. Today is December 6th, and this is Wyckoff Market Discussion, session number 1 of year 2021 and episode 228. In the upcoming events, Wyckoff Analytics are introducing the new cycle of the Wyckoff Trading Course, Part 1 and Part 2. Part 1 is devoted to the analysis, and those classes are conducted on Mondays at 3 p.m. Pacific. Part 2 is devoted to execution of your trading plan, of your Wyckoff methodology. And that class is on Tuesdays at 3 p.m. Pacific. And each Wednesday, together with Bruce, I conduct Wyckoff Market Discussion, and that is the class on the application of the methodology. And that also starts every Wednesday at 3 p.m. Pacific. You could also catch up Power Charting episodes with Bruce each Friday at 3 p.m. Eastern, live on Stock Charts TV, or catch those episodes later on their YouTube channel and on our YouTube channel. Also, I want to mention that Bruce has a very popular Wyckoff Power Charting blog on Stock Charts. So check that out if you have not seen this. A wealth of information there, and it reads like a book. So I would definitely recommend this. Usually our sessions, our Wednesday sessions, have rotational themes. And today, just because we have a lot of guests, and thank you for coming, we're going to show you all of the segments, and they're going to be very brief, but we will try to talk about all of them. We're going to go through the anatomy of the trade. Specifically today, we're going to talk about the DBA. This is the agricultural ETF. John Colucci is going to present just a sample of his scan, and he's going to talk what kind of scans, Wyckoff scans we could expect from John in WMD sessions, and John comes over every other week. We're going to look at a couple of student submissions. This is a very regular practice. Almost on each Wednesday, we have somebody submitting the charts, label charts, their work, where Bruce and I go through that work, and just voice our opinions as to what we see on that chart. And then today, if we have time, we're going to look at the communal Wyckoff watch list. This is the watch list that students create and that we curate, and this is a communal effort. So if you're not familiar with that, please go check this out on our website. Now, for those of you who are new to this particular class, so each quarter or so we have a promotion. This is a free open door class, like today's class. And we are lowering the price from $99 per month to the promotional rate of $79. So take this opportunity, and this offer is going to expire next Wednesday. For those of you who has been on the $99 per month plan, we already have moved you to $79. So you don't have to do anything. Just make sure that you just check your bank statement and that you see that change. But on your side, nothing has to be done. And obviously, we are welcoming new guests, new members. And with that, I want to ask Bruce a question. But first of all, Bruce, hi, how you doing?
Great. Gosh, it's so good to be here, and happy New Year to everybody. And welcome to our guests. So
absolutely,
this is a highlight of our week. It's a highlight of my week every Wednesday for us all to get together, collaborate, talk about Wyckoff, talk about current markets, and I'm just thrilled to be here.
For sure. So let me ask you this question. And very briefly, because we have so much material today to go through, we literally have 30 slides or so to go through. But the question here is, especially to our guests, what is the main benefit, Bruce, in your opinion, of this particular offering of this particular class?
The thing that I learned very early on, now this is going back like 40 years, is how to think like a market operator. And there is a way to think, behave, and conduct ourselves in financial markets as speculators. And this is not something that's easy or normal. I believe that Richard D. Wyckoff was trying to express these principles to students and to his readers. And unless we've had some kind of a mentoring process in our lives, now I've had great mentors. Ramon has had great mentors, and these are people that have come before us that have conducted themselves in markets in a very unique way. And the thing that I learned by following, watching these great market operators is that they look and act very differently in the markets than most people do. And I believe this is the reason why Ramon's Wyckoff trading courses are so valuable. And I believe that the Wyckoff market discussions that we're having every Wednesday are also an opportunity for us all to roll up our sleeves and to look at the markets as tape readers, as Wyckofians, and to be able to unfold the action of the market and then determine how to act appropriately given those conditions.
Absolutely.
That would,
Bruce, what a great point about the logic of the composite man, of the composite operator, of institutional money, of smart money. They have so many names, but basically, we just want to understand what the institutions that are on the correct side of the trade, on the correct side of the price cycle, are doing right now in the marketplace. Are they buying? Are they selling? What's their intention? What's their time horizon? So all of that, you could definitely either study in our classes or come to Wednesdays and see how Bruce and I, go through the market with the same idea and identifying specific spots where we see institutional presence. There is a question here from John. How do I take advantage of this promotion? Could you please send me the link so I can sign up? So first of all of you will receive an email from us with the link to this particular recording. So we're recording this session. This session will be posted on YouTube and it will be public. But if you would like to sign up for this class, come to our website, wyckoffanalytics.com, find Wyckoff Market Discussion and sign up. So that would be the way to go about it. All right, well, Bruce, we've got a lot to cover, so let's start with our regular segment. This is usual first segment that we go through. It's our market analysis, and we're going to start with the very, very long-term picture. This is the chart of the Dow Jones Industrial Average, and you could see, guys, that we're starting here at about 1928, a Great Depression decline, and then what happens then is of utmost importance to us because we're still in the current structure. And what is the current structure? Well, it's very simple. If we take the definition of the uptrend, higher highs and higher lows, and I think that everybody would agree with me looking just at this chart and at the structure of this uptrend. Well, we want to go a little bit more into the details of this uptrend. Well, first of all, out of the extreme oversold condition in 1932, we have a big rally. And then what do we have? We have a quite big formation here. We call those trading ranges, consolidations. This is a mega structure that lasted for about 12 years. And it was resolved by a substantial rally that was going on for about 25 years. And it was fueled by the revenue generation of the silent generation. We're going to be thinking about big demographical waves where we have the silent generation, we have baby boomers, and now we have the millennials. They are the consumer driving force behind a lot of economic activity that we have in the US and even around the world, as the world is now so open. So you could see that the rally is unfolding and then it stops, and then the price goes into another mega structure that lasts approximately the same number of years. The next rally is approximately the same number of years as the previous rally. So this pattern is still on, as we have had just most recently in the last 20 years, another mega structure, another trading range that started with the boom and bust in 2000, and Bruce is going to talk about this in the relationship to the IPO market. And then off the low in 2009, currently we are in this millennial generation rally that is aging at about 12 years right now. So we still have quite a room to go if this pattern is going to unfold exactly the same way. And what's important here is that if we look at the uptrend channel, we're still pretty much there. With all of these COVID declines and with the 2018 declines, we're still there. We have not violated this uptrend. Another point that I want to mention here, because obviously there was so much talk during the COVID decline as to this is the beginning of a much larger distribution. This is a distributional pattern, meaning that this whole formation right here since the February 2018 buying climax is a distribution. Well, we don't see it this way. We're seeing this as a reaccumulation with the sharp reactions in the middle of this formation. And the recovery of the COVID-19 low kind of confirms that. And in the history of the rallies, we always had those type of sharp reactions. Think about, let's say, 2016 in the same cycle. Here it is, 2015, 2016. This was 2011, sharp shakeout. Then if we go into the baby boomers rally, you're going to have a 1990, 1987, that was a scare. And then previously, you could see that in the silent generation rallies, we also had quite sharp reactions. So the long-term trend, this secular trend, is still up, and this is where we want to start our conversation. Bruce, your quick thoughts on the very, very long-term secular trend?
The three consolidations, megastructures, the green boxes that we see. Now, I came into the markets and into the industry at the towards the tail end of that middle green box, right where Ramon has that arrow. And so at that time, ironically, everybody was counseling, this is a stupid time, crazy time to be involved in the stock market. Nobody wants anything to do with stocks, real estate's the place to be, so on and so forth. Well, the thing that happens during the green phases is that value builds up in stocks during the green phases, and then the value is expressed or is put back into the stocks in the resulting uptrend. And so that is, in fact, what we've seen after each one of these consolidation periods. Also think of this as being like a reaccumulation structure that we would count with a point and figure horizontal count methodology. That's a super gigantic mega count, but large counts lead to large trends. And so this is a cause and effect type relationship. And so these are just things that we want to be thinking about. I think Ramon did a wonderful job of explaining this. And we can look at the prior uptrends that followed those mega green structures, and we can see that this uptrend that we're in now still has legs, still has a ways to go in comparison to the previous two uptrends.
All right, well, let's talk about something very interesting that occurs during those big rallies. So for instance, we could concentrate on 1987 and we could say that there was a distributional pattern right there. there was a distributional pattern in 2020. It's just the distribution was on the way down. So what happens afterwards? Because that's the most important thing as a confirmation of the whole rally. Are we going to have some kind of confirmation that the rally is going to continue, and how would we decide that that confirmation is valid? Well, one of the things that we look at, and Bruce has done such a great job on this, and I've contributed to this as well. I think this, Bruce, was kind of like a mutual collaboration on this idea and on this visual. We look at the breadth. We look at the New York stocks above 200 moving average. And it's a very, very simplistic tool, but it's so effective. And every time we have some kind of distributional pattern that is being followed by the downtrend, and then we go into the extreme, and I want to emphasize this, extreme oversold condition. Out of that condition where we have the majority of the stocks below 200 moving average, we have a very pronounced increase in breadth. And that increase in breadth actually is being created by the rotation itself. So the uptrend starts, and there is a lot of disbelief. There is a very bearish sentiment still, even as the prices are going up, as it was in 2009, as it was in 2020 of the COVID low. And then as we're seeing first money going into big caps as a flight to quality, then as the prices are going up, there is more conviction by institutions that now is the time to be in the market. There is some value there, so they have to be there, to actually reach the performance matrix that they need to outperform their peers. And then they start looking for value in other areas. So they go to growth stocks, then they find value stocks being undervalued, and they go there. And therefore, the breadth is expanding. So this initial move, this initial big wave of breadth to the upside usually brings us really quickly to the extreme overbought condition. So from the extreme oversold condition, we are going really quickly into the extreme overbought condition. So, and the same happened in 2020. And when we come to the high, to that extreme condition, usually the sentiment changes again. At this point of time, the sentiment is extremely bullish. And then we are starting to hear from analysts that we are in the overbought condition. That's true. We are. We can't really deny that. We see that. It's factual. But there is one thing that is extremely important. The prices in the stock could stay in that overbought condition for quite some time. And what happens is some of the stocks are going to be declining on profit taking, and still the breadth is going to maintain in a very good health condition. And look what happens during this period of time with the prices. And it usually happens, by the way, on the way out of the trading range. So the prices are actually advancing with the breadth being in that overbought condition. And that happens almost every time. Look at, again, at the trading range, at the breakout where the overbought condition is being formed. So the sentiment becomes extremely bullish. And then, we're hearing a lot, this is the time when we're going to have that reaction, and yet the prices continue to go up. And we're seeing this over and over again. Bruce, what are your thoughts on this? And I know that, you've talked a lot about this. So what are your main points here?
Well, notice that Ramon is really talking about and framing this indicator as a powerful trend tool. So much of the work that we do is oriented towards being really good trend managers, because we see that that's what happens most of the time in markets, is that you have good trending markets. So our emphasis, our concern is identifying trends and what is leading those trends, and then how to participate in those leading themes in leading trends. And so that's what really stands out to me here. The only other thing I would offer is that at the important lows, you have divergent characteristics in these breadth type indicators, which is very, very powerful. That was such a useful series of positive divergences that occurred in 08, 09, and really said that there were a number of stocks that were already being propelled into their important uptrends. Amazon was going up, Chipotle was going up. I mean, you could just go on and on. Apple was going up. These stocks were just not declining with the S&P 500 index anymore. And this tends to fool a lot of people, and they're extremely pessimistic while these stocks are just ripping upward already. And we're the true leaders as this uptrend got going. Same thing in 2011 happened. You can just see right there, eyeballing this, mid-2011, third quarter, you could see positive divergence in this indicator. You can see positive divergence in 2015 and 2016. Look at the very beginning of 2016, positive divergence. We can actually unpack this indicator and look at it, zoom in and look at it much more closely. But I just want to give you a feel for that, because we look at these things week in and week out as we do, as we get together and talk about markets. So there was actually a great divergence, positive divergence at the March lows. And that was very valuable to identifying the reversal up in the markets. Also, there's a different approach that you use when you're identifying distribution and the deterioration of an uptrend, because you can have deterioration in this indicator over long periods of time and still have a robust rising trend. But there comes a place where you have enough deterioration that tells you that you're going to start to lose the index. And the index is going to have trouble continuing its advance. And I would just point you to the end of 2015 there. You can see that the fourth quarter, you had a very low reading in this stocks above their 200, and the market was trying to rally up to its prior highs and failed. So those are the kinds of setups that we look for. You can see this occurring in mid-2018, right before the big drop into the end of the year 2018, fourth quarter decline. You can really see the failure occurring. And then finally, you can see a divergence at the January-February peak in 2020. January peak, and then the February peak was higher, and this indicator was making lower highs throughout that. So anyway, we can go on and on, but just that these tools are like, I think of it like X-ray vision. And so it's one of our spidey senses. And it's, I think, a very, very powerful concept.
All right.
Ramon?
Well, let's go forward and let's talk about short-term health of the market. And Bruce, here you're looking at advances versus declines. So what do you see
Yeah,
here?
similar concept to what we saw, we just looked at on the very long term on the prior slide, and you can see, look at the January peak. This is just 2020, January peak, February peak. And notice that the deterioration that was occurring. Now, how this is constructed, this is just advancers minus decliners, and it's a 5-day moving average just to smooth the data somewhat. But notice how low this indicator is mid-February, as there was one final push up in the S&P before the decline. So there is tremendous deterioration, and I actually profiled some of these breadth type indicators in the videos that I do power charting at Stock Charts, so you can see them there. And of course, we talk about them in great detail here. And so you can see there that there was already tremendous deterioration in that last push up, much lower high. Well, I only bring that up today because now look at the September peak. Notice where we were at the beginning of September, which I consider to be an important climactic high in the S&P, which had set up a range-bound condition. We defined it, identified it at the time. Look at the deterioration in the AD 5-day moving average, similar to what we saw in February, but we didn't get the big price damage that we had back then. Because that's pretty unusual to have that kind of price damage. But now, notice where we are now. You have a series of deteriorating lower highs, and the level that this indicator is at is the same as it was at the end of August, and it's pretty close to the level it was at the in mid-February. And so we can see that there is internal deterioration in the advancing and the declining stocks in the market at this point. And I think that makes it harder for the market to rally. And you can certainly see that in the way the market's rallied since November. It's been a series of diminishing thrusts throughout. And so we just want to be really aware of this, because this is a measure of the relative risk in the market at any point in time. And you can also see, I want to just point out, in March, notice the internal low in March of the AD ratio, and then notice where that ratio was at the final lows of prices in the third week of March. So that tells you what we are in effect looking for. You can even see a divergence here beginning of May to mid-May. Notice lower low in the index early May to mid-May, and then this indicator is making a higher low. So this is just great trading characteristics. So I'll leave it at that.
All right. Well, I'm just going to add really quickly that, to me, this indicator almost acts as a momentum indicator. You kind of could see the big waves of buying, where volatility of this indicator is just so huge. Look at the swings at the beginning of what? At the beginning of accumulation, and at the beginning of the area where institutions are actively establishing their positions. And every time this happens, the amplitude just changes depending on the consolidation. So in the reaccumulation, that amplitude is going to be a little bit less, but the concept is going to be still the same. During the reaccumulation, they're going to come in and they're going to seek value, and that value is going to be given to them by the weak hands that are selling their holdings, and that's how rotation happens. And then once they bought in, they are inactive. There is nothing really going on. So we either need to resolve this to the downside, and I think that the main point that we're trying to make here with this particular chart is that even though the long-term trend is up, we might have some kind of reactions along the way. We already experienced, at least one meaningful reaction, maybe two of them on the way up, but this was more prolonged. So I would consider this like the first stop in action in this new uptrend. We could have another one, so we have to be on the lookout. All right, well, Bruce, if we are looking for some signs of the top informations, sometimes they're going to be associated with the specific assets acting in a specific way. So here you are presenting to us an IPO chart, and how would you translate this into some kind of trading decision making?
So we're sort of switching gears here, and this chart is my attempt to express what happens when you get into the IPO boom portion of a growth stock advance. So we can see here back in my first experience with an IPO boom was 1983, 84. And you can see in the Nasdaq that there was a really good rally in the Nasdaq in the late 70s, which actually somewhat terminated in 1983, and that's that big red arrow. And that is an overbought condition, and ultimately led, if you look at the Nasdaq comp to the S&P, to a period where we had, prior to that, a very important growth stock boom in the markets from about 1976 to 1983. That IPO boom, when it ended, and this is my main point, IPO booms come at the end of important growth stock booms. And so the IPO portion. So we see in 83 that there's an IPO boom. It ends the advance or the leadership of the comp, the Nasdaq comp. And from 1983 onward until 1990, we had the value stocks, or the industrial stocks as measured by the S&P, dominating performance. So there's another point to be made here. This is a relative performance rotation exercise in investing. So we're always looking for the evidence of rotation, and we're also looking for the evidence of relative strength leadership. And we do that all the time, every week here in WMD, because we are always looking for where the leadership is coming and where it is emerging, and trying to identify that early on in the uptrend, and then continue to participate in that uptrend throughout. So notice this, notice that there's a big uptrend still in the Nasdaq stocks. They kind of go sideways and underperform until around 1990, 91. And then notice that in 91 or so, the Nasdaq stocks start to go up again and have relative outperformance to the S&P. Growth is now dominating value, or the industrial themes, or the more sort of senior blue chip names. And so growth is now leadership, and notice that this leadership went up all the way into 2000. And we all know the story about the dot-com boom. That's what this is. Look at the incredible spike of the Nasdaq comp to the S&P into the 2000 peak. And that was an incredible IPO boom, incredible. And so now we can see that following that, there was a terrible bear market in Nasdaq that took place from 2000 until around 2003. But even after that, the Nasdaq could not perform well all the way up until about 2009. And then at the end of that bear market, growth came back into a leadership position again. And notice that from about 2009 to the present, actually right into 2020, growth stocks have been booming as measured by the Nasdaq composite. There's other ways to measure that. And we also can see that there is this incredible IPO boom that is now taking place. And in 2020, a lot of IPOs were issued. And so we have just this big confluence of IPOs. It may not be over. There may be more ahead of us. The growth stock uptrend may not be done yet. But the point is, and I'm actually starting to see signs that there are other themes that are performing equally, comparably to the growth stock theme, like the Russell 2000. In 2020, it started to perform on an equal basis. First time in years it's been able to do that. There is some rotation going on. But the point is that we're in the boom phase for IPOs. I think that comes in the late stages of a growth stock domination. And I think that we're years and years into this now, and we should be looking in 2021 for evidence of rotation away from growth.
Bruce, let me kind of challenge you a little bit here. Bring in the same points that you gave us in the previous sessions. So I remember our discussion, and you bringing this, facts to our attention on the rotation between the growth and the value that was based on the presidential years by the Democrats and Republicans. And, obviously today is a very, profound day on the political landscape. And by the way, guys, we are not politicizing our views whatsoever. Whenever Bruce and I talk about politics in this class, this is just, kind of like what it is, factual, and we don't give any, preferences. So that's just our stand. That's our point always in these classes. But Bruce, looking at where Reagan came, right, and what happens afterwards, and then Bush Senior, right, if I'm correct, into 88, 92, we're seeing that value, maybe growth is peaking here, and then value dominates. And you've talked about that, right, relative to the presidential years. And then after that, Democrats are coming to the presidency with Clinton, and then we're seeing technology is just booming. Then Bush is coming to 2000, from 2000 to 2008, and value outperforms growth. And then Obama is here into 2016, and yet, with Trump, the next Republican president, we're seeing, outperformance here. So maybe just a break of the pattern. Could you just comment really quickly on that? That's just one point. And then the second point, really quickly, we could see how in 2000, this peak right here and this whole boom that we've experienced during those years is taking us to kind of like a very, very high levels relative to the previous peak. So even though, we are here and we should be cautious for sure, and we should be looking for the signs of that, IPO booms, growth boom, it could go for some time. So Bruce, with that, what are your quick thoughts on the presidential years and how that value and growth rotates with that?
Well, generally, when the political environment is such that they're lowering interest rates, it tends to, lowering tax rates, is that tends to ultimately benefit more value stocks and dividend producing stocks. High tax rates and rising tax rates tends to support growth stocks, because the whole idea of growth stocks is high internal rates of growth, high reinvestment of cash flow in the business, internal rates of return, so they don't pay dividends and they grow super fast. And so you are able to create capital gains which can be deferred indefinitely into the future. That's a really fast way to answer that. But I'm not at all convinced that the growth stock theme is over yet. I'm just seeing that there's a horse race here. Now I'll say this, back in 2000, there was a classic distributional top made on that climactic surge. You can see it a little bit in that monthly chart where there was a climax, a big sign of weakness, automatic reaction, and a secondary test that all produced a distributional Wyckoff top. And so I would suspect that when this advance is ultimately over, that we will see a big distributional top also, and I don't know when that is. I don't think we're seeing it yet. So the other thing that happened in 2000 that I think may speak to the current environment is when the growth stock theme broke down and there was a deterioration there and there was destruction of value in the growth stock area, there was a huge area that was very unloved, undervalued, unappreciated, which were the home building stocks, the banking stocks, the energy stocks, the commodities, and so on, that didn't hardly go down at all in 2001, 2002 into the final lows. And there was absolutely a boom in these stocks. in the early part of that decade. And so once that we get this end of the growth stock boom, whenever that is, and I think we can continue to participate in this, the thing that you can draw from that chart in 99, 2000, and even currently, is that the last part of the advance can be the most exciting and the most profitable. And so we don't want to just decide that we're not going to participate, but we just want to be very, very good risk managers, because these moves can go up much longer than imaginable. And so that would be my main thought about the growth stock boom, is we're now in the high growth or the high acceleration phase of that phenomenon, as we were in 99.
All right, great. Well, let's go to another chart that also kind of shows the same relationship between Nasdaq and S&P, and we could roughly say, growth and value. So, Bruce, looking at 2020, growth is definitely was outperforming, and looking at the actual Nasdaq composite, you're showing here that we are in the throwover and overbought condition. So how do you interpret that?
Well, just looking at the lower chart, which is relative strength of the Nasdaq comp to the S&P, and it's really similar to the chart we looked at before, but what I really want to express to everyone is look at the rising trend of relative strength in the Nasdaq compared to the S&P. That is what I'm talking about, that we've been in a growth stock boom since 2010, 2009. And that it's a very, very long period of time of outperformance. And you don't, as we saw in the prior chart, you don't always get outperformance from the NASDAQ. It tends to come in waves. So we've had this huge wave of NASDAQ and growth outperformance, and eventually that rotates, usually after some kind of a climactic condition, which we just saw 3 of them in that prior chart. So you can see that the NASDAQ price chart on top, and you can see a beautiful Wyckoffian trend channel, reverse use of trend lines, which means the primary trend line's drawn over the top of the market, and look how beautifully that trend line works. Now we're getting a throw over, which could be a sign of exhaustion, but we won't really know that until it comes back into the channel. But notice the relative strength. In 2020, the relative strength of the NASDAQ just went crazy. After a steady outperformance for, call it 9 years, all of a sudden the NASDAQ goes into this hyper rally state, and that hyper rally state is what created the conditions where Wall Street could issue these IPOs and get top prices for them. And that's how they do it. And so it's just amazing that this IPO surge all comes as you're having this incredible acceleration of dominance among NASDAQ versus the S&P. And like we saw from the prior chart, it is not always that way. So we are in some kind of an overheated state. And so I say, yeah, let's stay with the trend, let's continue on, but we will see exhaustion and distribution at the end of the advance, and we'll be able to identify that. We can do point and figure analysis on it and so on. And that's exactly what we're going to do. And we're just going to keep our eyes open for the evidence of the exhaustion of this theme. In the meantime, we continue to look for opportunities here.
All right, great. Let's move on and let's talk about the presidential cycle. And this work actually comes from Tom McClellan, Bruce.
Tom is a friend of ours. He is a fellow blogger at stockcharts.com. He does incredible work. And I love this chart because we've been using the seasonality charts for the stock market So just to describe what we're seeing here and what I think is so unique about what Tom has done is that if you look at the chart on the left, this represents the 4 years of the presidency, starting with the election. And Tom does a unique thing. He marks the actual election day as the vertical line on the chart. And so that's election day. And you can see that following election day, there's a bit of a rally in the market. We've had exactly that. And the green line represents when you have a first term administration, first term president from a new party. It's exactly what we have now, is that we have a first term president who's coming in, who's from the party that was out of power. And so in the first election year, you can see that it tends to be a trading range for the first half of the year and into around May, and then there's weakness into the October-November period. The kind of the dark red line, maroon line represents when a second-term president, and there's much more of an upward tilt or bias to a second-term president's, the stock market's performance during a second-term president. So that's not the case here. And so, and then you can see that somewhere in the course of the second year of the presidency, an important low is put in, and that represents a phenomenal investment opportunity, and then an uptrend follows. And that makes sense because a new president from a new party oftentimes is brought in to fix problems, and they will institute their economic agenda, and it often takes a couple of years for their agenda to be initiated, voted on, approved by Congress, initiated, and then put to work. And the market tends to like that. An example of that was Ronald Reagan. He comes in 80, he institutes all these economic programs, lower taxes and so on and so forth, and in also breaking the back of inflation. And it took until the second year of the fall of 82 before the market started to respond to that, and actually the economy was in quite a recession into that. So this chart on the right is just a close-up of the year 20, or in this case, we're looking at what Tom was expecting in 2017 as a result of the a first-term president. And so this is what he was looking for the year. So it's just sort of a blow up of what we're seeing over here on the left, on the chart on the left side. So Ramon, your thoughts?
Yeah, I really like, this whole idea, and I was actually about to say the same thing. New president, first termer comes in, to fix the problems, set up the agenda, and then obviously it takes time, even just to go through the, introduction of the new administration. Imagine how many people have to be, literally replaced, from the previous administration to the new one. So it takes time, and it takes time, to push that agenda, through all of the channels that they have there. And then once it's, once it's on, then yes, the market really likes that. All right, Bruce, we're at 350. So let's just go to the next set of charts. This is very interesting. Well, first of all, I want to say that Bruce just does such a tremendous work that I don't think that you can find this anywhere. And without any over exaggeration, and not just because Bruce is my friend and we've been working together for a long time. I just know this business. I just know these people. So Bruce, in my view, is the best point and figure horizontal counter, if we could call it this way. And I just like throughout all of the years that Bruce has been showing us P&F charts, and this is an art. You really have to understand what you're doing, how to create those horizontal counts on the correct scaling. So this is always an enjoyable part of our discussion. So Bruce, what are we looking at here? There are two charts. Please walk us through those.
Well, you know, and the thing I love, and thank you for the kind comment, but what I love about point figure is that we get a perspective about things that is really hard to get from a vertical chart or from other methods of technical analysis. Because the thing that point and figure does for us is it gives us a way to be able to measure the potential of a move. We talked about relative to the Nasdaq about how there was a distributional top that was set up in the Nasdaq back in 2000, 99, 2000. Well, here, this chart on the left is, and you can do point figure on just about anything. This is 10-year Treasury yields. And so here, look at this, in 2018, 2019, distributional pattern. So what that means is distribution means that this is based on this data series represents the potential for falling interest rates. Well, then the question becomes how much can they fall? How much can rates go down? And so you can see here that at the top of this range in this yellow box, it's about 3.24% yield down to about 2.6 yield at the bottom of the range. And this is a classic distributional type structure. Even the interest rates act like prices do in the way that they trade. So you can see one final attempt to break down in a rally up under the ice here, and we count from right to left, and we count that, and it gives us an objective. And just counting this would suggest, well, what does this mean for the economy? And so if interest rates can fall from call it the 3% area down to, we have an objective range here that goes 1.26% yield down to 0.62% yield. It's like, my gosh, that is a huge decline in interest rates. What does that mean about the economy? So then look what happened in the midpoint of the downtrend is a redistributional structure forms. We can count that. And so I put the math here so you can see how the math was generated. And that is, it becomes a confirming count, a confirming redistribution count. And so, and this is a great timing tool because when the redistribution count approximately matches the distribution count, then that's about the point at which the trend is ready to resume. So it's sort of a little bit of a timing tool, which was taught to us by our great mentor, Dr. Hank Pruden. And so now look at what's going on here. We have something that looks an awful lot like a classic accumulation structure. And so we have climactic decline, big automatic rally that's generated, and then a range-bound condition with a series of attempts to test the lows of interest rates. There's a spring there. And then now we have a rally from what could be a phase C low up to the resistance area. Now, does that mean that we couldn't have an attempt to come back in to the accumulation structure, again, making the count even bigger? I don't know, but I just took the count as it stands right now, and we have what we call 3 segments. And so I've noted those, and we just segment A, segment B, segment C, and so these are just approximations for how far this could go. And I usually expect that when you get a fulfillment of a segment, like you get a rally in interest rates. So this is basically indicating, just using point figure analysis, that we're going to get rising interest rates. And so if we just draw that one conclusion from this, that's going to be remarkably useful information. And so if we get a rally up to the A range here, which is about 1.54% up to 1.92, and I suspect that if rates rally to that level, that there will be some consolidation there. and a reaccumulation potentially that takes us up to the next level, which is B, and then at the next level, which is C, and this level C actually counts up to 3% interest rates. And so here we are at interest rates being in the area of call it 0.96 roughly yields in the 10-year and have the potential to go to 3%. So we're not anticipating anything. We're not doing any kind of projections or anything. We're just counting the structure. We're just looking at it, evaluating whether it's accumulation or not, and then counting the structure, and it gives us the potential for 3% interest rates. Now, the chart on the right might be the reason why. And first of all, I think that 2021 could be a very good year for the economy. And so we're seeing lots of industrial type themes and stocks and so on. And we're seeing commodity prices rising. We're seeing all this evidence that the economy is poised for some kind of an advance. Well, the other thing that we're seeing here, and everybody's talking about it now, is the dollar. Well, the dollar did a distributional structure back in early 2020, and this distributional structure, and now I'm just using the UUP as a proxy for this, but you can see now that we are now in the midpoint of fulfilling the distributional range for the dollar. I suspect, even though I think it could go potentially down to the lower end of this range, that we are pretty close to the decline in the dollar stopping for the time being, and that there could be some kind of a redistribution potentially for the larger distribution count, which goes even lower. And so at this point, I think that we should look for evidence of consolidation, stopping action and consolidation of the downtrend in the dollar, and then see whether or not, and we can wait and just watch the trading and see whether or not it has the attributes of accumulation or redistribution. And but I believe that we should start looking for some kind of a important low in consolidation in the dollar here soon. Ramon?
Fascinating. First of all, on the yield itself, yeah, the question here is, are the rates going to go up? Are they going? Well, they are actually, increasing right now. So, but we're still in this trading range formation. So I think that the question that Bruce had in terms of the duration of this formation, could we have another segment where maybe we have another leg down? Maybe it's not so pronounced anymore. Maybe we're consolidating somewhere here, increasing the count, and then it starts to go up. And then obviously with the dollar, this is favorable. Fall in dollar. This is something that they wanted for a long time. They got it, and now it influences so many other asset classes. Specifically, Bruce, we talked a lot about metals and gold specifically, and inflation and so on and so forth. So
sure, you're seeing materials and I'm hearing about all kinds of different surging inflation of prices, which somewhat is related to the dollar. But the other thing, it's great for U.S. exports. And so this is one of the reasons I think to expect the economy to show signs of improvement in the year ahead. And also a weak dollar tends to drive interest rates up. The other thing that drives interest rates up is a strong economy. And so if the economy starts to heat up in 2021, a big part of the reason interest rates go up is because the competition for capital. And so as you see the demand for loanable funds at these banks, they start to bid up the price of money, which is interest rates. And so this could very well be an important sign about an expanding economy in the next year.
All right. Well, let's go to the next segment, and we could kind of build a bridge here, talking about the gold and silver and Bitcoin to a certain point. So, Bruce, falling dollar, how does that influence gold, silver, and Bitcoin?
Well, I just thought these charts were really interesting because I was looking at the Bitcoin chart, which is on the bottom, and the dollar chart on the top. Now, the dollar chart is monthly bars. I mean, not dollar, but gold. Gold chart is monthly bars. The bottom chart, Bitcoin, is weekly bars. The climactic peak in gold occurred in 2011. Climactic peak in Bitcoin occurred in 2017. And so but look at the family resemblance between these two structures, gold and Bitcoin. And of course, what we're seeing here is that Bitcoin is, even though it's a very large structure going across 3 years, is actually leading the way out here, where gold has rallied up to its prior 2011 peak and has been, as expected, consolidating at this price level from 2011. And then, of course, in the middle, we have silver. And silver, that's a monthly bar also, but that monthly bar is, that monthly chart is gigantic. That's a gigantic structure. And it could very well be that silver, which has just come to life after a big spring in 2020 at the COVID lows, has just had just a launch off of the spring low, which is classic Wyckoff structure. And now it's just consolidating its first advance out of this very large accumulation. And so silver looks very exciting. Ramon, I'd love to have your thoughts.
Yeah, I just want to add to this is that whatever the rallies we have had, advancements that we have had in this assets, um, this looks just as it is just the beginning of a much, much larger trend. Usually when gold trends, the most recent big secular trend that we've experienced in gold started in 2002, and then it ended with the climactic top in 2011. So you could see that it took years and years for the price to advance. So we are probably somewhere just maybe like midway. We stopped here because this was an all-time high, and well, obviously all of this COVID-related events that unfolded. But usually this is the place where we're gonna stop, and we're gonna consolidate. We're gonna test that penetration of that all-time high resistance. Silver has uh, an immense potential and immense causality to create a very substantial effect, and we didn't even touch the all-time high. This is a campaign, and then Bitcoin, and we're discussing Bitcoin with Alessio each week. Please check out his blog and also the video series that we do on a weekly basis, where we discuss all of the crypto assets. Bitcoin is attracting such a huge attention from institutions right now because there is more liquidity. There are more tools to participate in that market, and they have to. Now they have to have crypto assets, and specifically Bitcoin, in their portfolio as the counter asset to other instruments that they have. So we see just such a surge of institutional participation right there, and usually that doesn't end right away. It takes time for the trend to unfold. So all of the three charts are kind of like my favorite, Bruce, at this point. All
Well,
right.
they are. They're just big campaign structures. And we actually have been campaigning gold and to some extent silver and Bitcoin for quite a while now. So this, these have worked out really, really well and continue to have tremendous potential.
Yes, and I know that you have a lot of gold mining and silver mining stocks. I have a position in gold that I don't even look at. I think, that position was open somewhere here at the beginning of 2019. It's in my IRA account, and, it's just there, and that's it. Until it's going to hit like, higher targets, I'm not even going to be disturbed. I have, positions in silver as well, and Bruce, I know that you have too. So those were opened off the COVID low. These are the positions that you're going to hold on for quite some time. I mean, obviously, depending on your intention as a trader.
Now,
Okay.
I would just encourage people to go to my blog and go back, and you can see that I've recently written articles on silver, and then also back at the important kind of turning points in gold, I wrote blogs, and you can pull up those charts, click on them, bring them current, save them if you're a stock chart subscriber, or print them off. You don't have to be a subscriber to get those charts. And so go look at those. And so here is a point and figure chart, 3-box reversal, standard scaling of the GLD. And this is really the same structure that we looked at, but this time we're doing a point and figure chart, substantially large accumulation, cyclic accumulation structure here. And so there are 3 counts, 3 segments at work here. And you'll notice we went right to segment A targets. And so we went right to those targets and corrected. And I believe that it's possible that this correction, attempting to turn now upward, but still in that confirmed downtrend, you can see that in the columns of X's and O's, but that if we can see gold GLD start to go sideways here, I'm expecting a reaccumulation count for a count up to that 240, 250 level to be the next action that takes place in this structure. And so I would be looking for this to morph into a reaccumulation that can be counted for the move up to that 240, 250 level. And then you can see there that there's a count of the whole base that goes 312, 322. So there's quite a dynamic potential, let's say, in gold. And then, of course, the other thing about it is to keep in mind that chart of the dollar that we just looked at with even lower price potential in the larger distribution count. And so that could help to drive gold and silver and possibly Bitcoin. I think they're all benefiting from the same phenomenon of finding alternative currencies to invest in. Roman?
Right. Yeah. Well, again, we've talked about gold for so long, it feels like years and years. It's a long-term campaign. We're going to follow this in these classes. So for those of you who are thinking, what's the benefit for this class? That's a direct benefit. We have a lot of students that come to us and they say, well, thank you for keeping me in the specific trade. Why? Because you discuss, your campaign thoughts and how you behave in the marketplace within a specific asset, and we follow. So here is a great example of that. Okay, well, Bruce, let's this is all long-term pictures that we've discussed, and usually that's what we do in the initial class for the year. It's important for us to discuss long-term outlook. It's important for us to discuss what potential structure the year could shape into, and then going into the short-term structures, and specifically in the next class, we will be discussing industry groups. We will be discussing a lot of stocks in those industry groups, and we will be showing that emergence of the leadership, especially going into the new year. And we usually start that using the top-down approach with the sectors. So here are our sectors, and this is a 6 months picture for each and one of them. At the bottom of each chart, you have a relative strength ratio line that shows the performance of the sector relative to the S&P. So with that, Bruce, what catches your eye in terms of, let's say, let's talk about first outperformance, and then let's talk about underperformance.
Well, and you'll see us always putting these relative strength lines on these charts because relative strength just is such an important attribute of finding leadership and emerging leadership. Well, look at materials on the left middle chart and notice how materials since, and this is just since September, has been rising in a rising trend, higher lows, and now has just accelerated out of a tight consolidation area. And materials is a very dynamic sector at this point in time, and looks as though it wants to go up at an ever faster clip. Now compare that to say communication services, the top chart there, and you can see, look at the relative strength. So the relative strength is sagging into the end of the year, and it had a pretty good run from September onward, which is encouraging, but now it's starting to lose some of that relative performance. And so we'll keep an eye on that. The thing I'd be concerned about is it falling, if it falls back below the peak of its early September high. And so that would be concerning. And then the other group that looks a little tricky to me, troublesome, is technology. So here, and this is such an important psychological group, and notice how it's turned down here very recently with a strong market and is back to the levels of the September high. And so the question I ask is that an upthrusting action of the September peak? And if it falls back in, can it go back to the bottom of that big trading range? And if it does that, I think that it will devastate a lot of speculators because they're just not expecting that.
Right.
The other group that I think is so interesting is energy, because it was such a dog for so long. Look at the relative strength. It's just down, down, down into November, and then all of a sudden it just comes to life on a test of the early October lows, and look, it's just going nearly vertical, and now it's rallied back up to its early December peak, and it looks like it just wants to trade very dynamically. And so that's I think, a very interesting change that's occurred in the energy sector in 2020. Roman?
Yeah, so let's go through this from a different perspective now. How do we teach this material, right? So how do we teach the emergence of a specific theme? So we want to see on these charts, and this is such a good representation of this idea. We want to look at the relative strength and obviously see what Bruce has just noticed, on the energy sector. It's the outperformance out of what? Out of the downtrend, where the prices were depressed, where there was no big interest, institutional interest in that particular theme. And now look at how the relative strength starts making higher highs. There is a lot of momentum behind the relative strength outperformance. So there is a faster movement of money into this theme. And then the reaction itself, we would be judging, the reaction of the price and then the reaction also on the relative strength. So with that, right away, when you have multiple charts, you could go really quickly through them and just basically say, okay, well, what is of interest to me here? Well, I see that healthcare is starting to outperform, the price is breaking out, and the relative strength is improving. I'm seeing that industrials also are trying to do the same. They were in the established uptrend, both price-wise and relative strength-wise, and now we're trying to rally both in price and relative. We're seeing the discretionary continuing their outperformance and leadership, and out of somewhat of the reaccumulation range here, trying to break out, and the relative strength is confirming. Materials, and we've talked about this, is doing the same thing. And then financials, which is a very, very important segment of the economy, and also related to the interest rate rising and inflation. This is something that is confirming that interest rate rising idea. So I would be looking at it this way, and this is how we're doing this in this class. And then everything else is kind of like, okay, well, let's go and kind of like question what is going on. A downtrend, a downtrend, a downtrend, a downtrend, a downtrend. So these are the themes that we will keep an eye on, but we will definitely not participate aggressively. We want to be in the themes that are emerging in both price and relative. And again, in the next class, next week, we're going to go into the industry groups of those emerging sector themes, and then we're going to scale down to the stocks level, and we're going to talk a lot about different stocks. Okay, great. Bruce, let's jump to another segment, and we are at 4:15, so we have around 15 minutes left. Let's bring up one of our Wyckoff Analytics stars, John Colucci. And John has been such a great contributor to Wyckoff Analytics material in general. John has had a couple of specials on scanning. And this is not just a simplistic scanning that John is developing. This is in line and in the context of the Wyckoff price structural analysis. So whatever John is doing with scanning, creating those wonderful scans, they are all related to the concepts that and the ideas that we discuss in our classrooms. John, Happy New Year. How are you doing today?
Happy New Year to all. I'm wonderful today.
All right, great. So let's just jump into this. What could we expect from you in 2021?
Well, coming up for this year, we'll do some scanning for the big 2020 winners. I think around this time of year, we see a lot of that in the press, and often wonder how they come up with that, or how did I miss that? Well, we can write a little scan that finds those for us, so you can do your own thinking. We can scan for a large cause. We discuss a couple of areas that had significant cause built, and we'll show the folks how to scan for cause. We can also look for a very Wyckoffian concept of a low volume pullback approaching a critical area, maybe a last point of support sort of thing. Very, very key element of structural analysis. A lot of relative strength scanning coming up. One of the great tool kit items for the Wyckoffian analysis. We can also look at how some indicators can help us with Wyckoffian structure. Really, Wyckoff is not indicator driven, but we do have to find the structures that we want to explore analytically. So we can look at indicators that will help us do that. And finally, momentum scanning, big issue, because we like momentum moving up and through a structure, usually associated with a phase C analysis. And we'll take a look at that this year. So lots of different things to help us build a skill set in looking for the stocks that the structures we study tell us we should be looking at. We have a sample scan. We'll take a look at this coming up next session. This is a scan that will help us find stocks that outperformed in 2020. Not only that they outperformed, but they accelerated into the end of 2020 so that they kept going. This is a scan that anyone can take this syntax and drop it into stock charts and run the scan for themselves, but we pick up a lot of concepts with rate of change, how fast do things change, over what period, the slope, a linear regression analysis on, in this case, a moving average, and we also sort by relative strength. So we use sorting in structural scanning as an independent element of the scan itself. This particular case, relative strength, orders our results for us. So those are some of the concepts we have coming up this year. It's going to be a very dynamic year, and looking forward to presenting a variety of scans to help folks out.
John, well, thank you so much. And I just, on behalf of Wyckoff Analytics, I just want to thank you for such a great contribution in 2020 with all of the scans that you've presented to us, to our students. We do use those scans. And this is another value proposition for those of you who are guests. You know, if you are into scanning and you want to create, you know, a series of scans or develop those scans that would catch the stocks or the patterns, the setups that you're looking for in the marketplace, John is just doing a tremendous job. And by the way, do check out John's blogs on wyckoffanalytics.com. John has written multiple articles, multiple blogs on that. And obviously, for those of you who are more inclined to go into the depth of scanning, John has two specials that you could find in the on-demand section of the Wyckoff Analytics website. John, thank you so much. We're looking forward to, again, diving into the scanning world. So looking forward to that.
Absolutely.
Thanks, John. I just want to say that I'm constantly being asked about scans for Wyckoff-ian setups. And it's the beauty of the work that John does is that John very elegantly, creatively, and I think with a remarkable efficiency and simplicity to his scanning concepts, has created a whole library of Wyckoff-ian scans for us to use. And at the same time, he's teaching us how to do it. And so I just think this is an incredibly valuable segment in our every other week Wyckoff market discussions. And John, thank you so much.
Well, thank you, Professor Bruce. Appreciated. We are going to put together a compendium of last year's scan, which will be made available to subscribers to WMD. So you'll get a view of many, many scans over the year, and you can deploy those yourself as you think fit.
Wow. Wonderful. Great idea.
Thank you, John.
You're welcome.
Thanks, John. Happy New Year.
All right. Let's go to another segment. We have about 8 minutes left, Bruce. So let's talk about what else do we do? And those are rotational themes for us in the WMD classes. So anatomy of the trade, what is it? So we pick a certain asset or a stock. In this case, you know, we're following DBA, which is the agricultural ETF, and natural gas. Those were picked by us discretionary at the time when we thought the position should have been opened. And what we do with the with students in this segment is that we go through the chart, we analyze it together, and then we go through kind of like a soft poll where we asking people, what should we do with this position? Should we keep it? Should we keep it and add to the position? Should we keep and take some profits, or should we close the position completely? So, and you know, for the fun of it, let's do it today. So please be ready to voice your opinion as to what you would do here. And Bruce, looking at the DBA, and quickly discussing the structure, let me just quickly go through this. We were in the downtrend. We had two stopping actions here. You could obviously question where the selling climax should be. But then after that high volatility, we're seeing how volatility dimensions throughout the whole trading range. We're seeing multiple tests. We also see in the last test in the form of the spring with the local test that is testing that particular spring. We also see in the formation that the volume signature is increasing, suggesting that institutional participation is increasing. And with that stopping action and lower volatility, the bias is to the upside. So we are picking up this particular ETF during the trading range as the first position is being opened, and out of the trading range. And I thought that was a really good two places, considering especially second add-on here. Why? Because usually we would be anticipating here what? Some kind of backing up action after the sign of strength. But the trading range, the way how it formed and the way how volatility got out of the way suggested continuation to the higher level, probably to this target, and that was fulfilled. We're seeing somewhat of the smaller climactic surge here, and our anticipation after this reaction is that we're going to go into the trading range, and that was done exactly that way. So here in the trading range, we're just adding to the position. We're adding actually in phase B, my favorite phase to add. And then I thought that the next two add-ons were just like so beautiful. I really like those, Bruce. And, Bruce and I, we've discussed those a couple of times. First of all, this was a very difficult add-on. It looks easy now when you look, in the retrospect of what has happened. But here again, the big question is what kind of pullback we're going to have. Is it going to have some kind of duration or extended duration, or is it going to have some kind of more pronounced move to the downside? So our answer, as we were discussing this in the classroom, was to add right now, because the price is still has a lot of momentum and strength to go above that level. So that was a great add-on. And then we were kind of like enjoying and laughing a lot in preparation for this session with Bruce, this last add-on that we had right on this last bar. That shows some emergence of the demand. And obviously, we're doing a lot of price structural analysis here. We're doing a lot of tape reading analysis. And Bruce, just looking at this whole thing, I'm still, in the camp of the bulls. I'm still saying that there is a lot of potential here, and we should be in this position. What's your quick view of the DBA?
I take us back to that UUP chart. I think that there's an element of rotation into these agricultural themes, partly as a result of the weakening dollar. And you can see that the dollar has been weakening, possibly accelerating its weakness as the DBA has been accelerating here. Notice the very high volume. I suspect that we are probably in the throes, relatively close to some kind of a stopping action in DBA after a spectacular rally, and that there's going to be some kind of a pause, and that this is going to create a potential opportunity to initiate additional trades. And so I say that for now. Are we going to do the poll today?
Yeah, and let's just do it a soft poll. So please, guys, write it down in the questions box. What would you do now? Would you keep the position? So you could just, have the number there. Number 1, number 2.
So while they're voting,
number 4.
I'm just.
Go ahead.
While they're voting, I just want to say we're doing this as a real-time trade, that we are actually doing this in class on Wednesdays, evaluating these trades. This is classic Wyckoff tactic, strategy, execution, and I just can't imagine how this could be more textbook.
Mm-hmm.
Yeah. This is an absolute textbook thing, and we're doing it real time and demonstrating how Wyckoff would scale up a winning trade off of the completion of accumulation. The only thing I could think to add, Ramon, would be to buy the test of the spring there in July, and that. But oftentimes this is just reality, is that you see the spring after the fact. But immediately when you see phase C starting to develop, immediately that puts us in the emotional place to start to prepare our execution strategy for scaling up the trade as we leave phase C into phase D and a new uptrend. And that's exactly what this DBA is. at this time. So
And
I
sometimes
just want to
this
say that.
doesn't happen because we are not there. This is a recurring segment, a rotational theme that we have in
Yeah.
WMD. So sometimes we miss those spots, but
Yeah.
regardless, we're following this trade. A lot of you
Right.
guys are saying number 3, keep and sell some. I think this is a really great place to take some profits and maybe even to kind of like even out your risk, for this position. So yeah, in line with what was Bruce was saying. So this is great.
Yeah.
Yeah.
And
Mhm.
I love it.
Bruce,
Yeah.
we were talking about the dollar. We are talking about the DBA. Let's quickly look at the PNF of the commodity index, and we are exactly at 430. So we probably will spend another 10 minutes here, guys. For those of you who could stay with us for another 10 minutes, but we'll try to go really fast through the last 2 segments. So what do we see here, Bruce, for the commodities?
Yeah, so I'll just keep this really short. Notice the distributional structure. Now, counting distribution is tricky, and we talk a lot about that here, but we have a count that is, I think, a very appropriate count for the distribution structure on CRB. Look how well it worked. And so it took us right down into that accelerating climactic surge into the lows. Beautiful. Now we have an accumulation count. I've taken the smaller count here, but look where it takes us. It gets us back up to the highs. So you can see that we have a return back up to the highs in CRB, and we're not there yet. And also the count could be larger, and Ramon just drew that. And so that could very well be the case, that that count gets stretched out and becomes even bigger. So I'll just say that.
And everything is so connected, Bruce, right? I mean, like the dollar, the interest rate, the commodities, and when you look at the actual trade, how do you actually trade that? Well, you take that idea that inflation might, accelerate, go up, and then you pose a question to yourself as to what assets will benefit from this. And obviously, DBA agricultural ETF was one of those ideas. All right, another segment that we have in WMD, and again, this is a rotational segment, is the submission by students of their work. So this is where students bring us their charts, and those are not blank charts. Those are, pieces of work that our students do, and they obviously do this from the Wyckoff perspective. And here is an example of this. This work is done by Lena, and Lena is actually taking Bruce's idea of the rotational theme from growth to the value, and Bruce has been talking about this for months now. And she's adding a very interesting element, Bruce, the PNF for this relative strength chart. So could you please briefly comment on this work?
Yeah, so we've been studying this. This is the Russell 2000 as a measure of small cap and value oriented stocks, which have been massively underperforming for a very long time, to the triple Q Nasdaq 100 ETF, which is the growth proxy of the market. Notice what's happened really since March, April, is that the Russell 2000 and the triple Qs or growth have been performing approximately equally. And it has, as Lena has beautifully done, she's labeled these accumulation areas on the chart, and notice that since September, the Russell 2000 has been outperforming growth. How about that? That's like really interesting, because it shows that there's some element of rotation going on. There's deep value in the Russell. Growth is somewhat extended. Like I said, they both could do well for a while here, but notice that you're starting to get a little bit of dominance from a formerly undervalued theme. So Lena's done this brilliant thing, and I love what you've done, Lena, because here in the blue box, you can see this accumulation structure where she's done a point and figure chart on this ratio. And so that is so cool, because I'd love to do point and figure charts on all kinds of different data series. Well, here's a perfect example of a relative strength point and figure. And from this, you can see here that we have counts that go currently, it's around 62.5, this ratio, and the count goes up to 100, potentially 48 plus 52, 48 plus 55 takes us up to 100 to 103, and roughly. And so there is a lot of room for IWM outperformance from here on if it can continue to pull away from this accumulation structure. Great stuff. I really like what you've done here.
Brilliant. All right. Well, with that, let's quickly talk about Russell, Bruce. And we've shown this chart in the previous sessions. So are we seeing higher targets?
Yeah, so here's a point and figure. Now, this is an example of an intraday point and figure. And so 60-minute data, 3-box reversal method, and 1-point scaling. And you can see there's a reaccumulation structure where there's a pause after an uptrend. And this count, which once it fulfilled it, it just took off again. And at the time of this chart, December 17th, it was around 196. But look, the count goes 286, 304. Lots of room in the Russell to continue to go higher.
All right. Well,
so this is an uptrending campaign.
If Russell is going high and we're talking about some underperformance by growth, we still want to check, where tech stocks could potentially go. So this is the chart of the Nasdaq 100. It means this is 1 hour. Why 1 hour on the PNF? Because the volatility of the COVID decline and specifically the consolidation accumulation range that has happened requires us to go to the lower time frame and include that intraday volatility into the formation of that accumulation. The original counts are showing 15,500, 16,000, and then that count is being confirmed by the same target and objectives from the most recent reaccumulation range. So our whole idea is that even though we're seeing that rotation between growth and value, still growth and specifically tech stocks will go up and can go up. It's just that they might go up underperforming. Another idea that I want to throw here, and maybe Bruce, we could develop this a little bit more in the next class, is what I'm seeing from the technology, just because I trade a lot technologies stocks. You could definitely find so many pockets of outperformance in the technology, and specifically in small caps or mid caps technology stocks. And oh boy, they are high flyers. So there is, if we would be even more specific about the rotation, I think that there is a rotation from big cap growth stocks into small cap growth stocks, and also into value theme in general. So
I just love that thought. That's a great thought, Ramon.
Yeah, and I think we should develop this a little bit more, Bruce. So let's definitely, bring this more in the next sessions.
I do think small cap growth is ignored because of these FANG stocks and their ilk just take all the oxygen out of the room. And so there's a tremendous number of really dynamic smaller companies that are growing at a fast clip that could very well get rotation. And so I think that we should really work on that in the weeks ahead.
Absolutely. And again, for those of you who are new to WMD, this is kind of like the regular first 2 sessions for the year. In the next session, we will talk about specific industry groups, specific stock ideas. So we'll go through that for sure. And one last chart that comes from France. And this is a biotech stock. Okay. The symbol is LGND. It's a little bit, I can fully read this, and hopefully, guys, you could see this. This is another example of how, in this case, Franz is not just one of our students. He is a contributor. He has a blog. He is a part of the Anatomy of the Trade video series that we have, and also Franz is helping out with our forums on the website. And you could see how much effort and time was put into this work. Bruce, what are your quick thoughts on this particular stock? And Franz has mentioned in the email that this is a campaign stock for him.
Yeah, so I've been doing a lot of focus on biotech also, and have come up with some great candidates. And I love to trade the biotechs because they trade purely from a Wyckoffian perspective, that they're very hard to trade on fundamentals and things like that, but they trade beautifully on the Wyckoff tape reading concepts of accumulation, reaccumulation. And we're seeing that here. And I'll just mention the chart on the top right is a beautiful accumulation type structure, and it resolves itself up and out, and now it's in a reaccumulation area, and the chart below it is the weekly. Am I seeing that right? Tell
This
me.
is daily right here.
Daily, and the one above it is
2 hours, actually.
2 hours. Okay, good. So thank you, because you can see those structures in both, and he's chunk sizing down into the shorter time period to fine tune his entries. And so this is it's just a great case study. And we do these. This is one of the things I love about WMD is meeting on Wednesdays, because we'll often have our people submit symbols that we can, that they're looking at, that we can all study together. So many good ideas come out of that. So many interesting ideas, because we're all have our minds or our eyeballs on different things, and you look at it and you go, that's such a great theme, such a great idea. And so we're collaborating on sharing ideas, and this is a good example of that. So I'll just leave it at that, but this is great work.
All right. Well, guys, this is it for today. Thank you for being here. Don't forget that the current promotion is going to last for 1 week until the next session. It's $79 per month. You could go to our website, wyckoffanalytics.com, under the Live Education, find the weekly Wyckoff Market discussion class, click on that, and then just subscribe. So this price is going to stay for 1 week. Also, this session will be available on YouTube channel, and we'll obviously advertise it, throughout different social media outlets that we have, on Twitter, on YouTube, on Facebook. So you could find that session if you didn't have a chance to go through all of it. Bruce, great start for 2021. I'm looking forward, to working with you and the whole class in this year. Hopefully, it's going to be less volatile, but even more profitable than 2020. So, very exciting.
Happy New Year to our wonderful Wyckoff family, and I'm looking forward to this year ahead. It's going to be very challenging and interesting.
Thank you, guys, and bye-bye.